Alright guys, so every time I make a video I wish there was a way to make it short and not long-winded, but it just isn't possible. There's just too much to cover. There's just so much going on in the markets that needs to be addressed. So today what I'm going to try to do is explain the market to the best of my current understanding from a macro perspective. Okay, and so what are we looking at here? We're looking at the S&P 500. The reason being that it has existed longer than the Nasdaq. It essentially is very similar anyway. So, and then we're going to compare it against certain statistics. Okay, so the blue line is interest rates. This dark blue area, actually, I'm going to change it to a different color just so it's more distinguished. Let's just make it that and make it that. And make it, why is it gradient? It's so annoying. Oh, I'm gonna have to make this also, oh, that's why, there we go. Okay, so this is the US population. So that trend isn't gonna be that obvious unless you look at it on a larger time frame, right? And then it's relative to the S&P, so it kind of squishes it, so it's kind of hard to see it. It's a little bit redundant, but obviously you can see that the population of the US is in a slight uptrend, right? I mean, it's always going to be going up from here on out, right? It's been increasing since the US came into existence. So that's not really that important, but that's just to show you that it is correlated. So what I'm going to do is attempt to explain the correlation between these different statistics. So I said we've got interest rates, we've got population, and then this is the inflation rate. Okay, and so I'm not going to dive too deep into what these all mean, but I'm just going to speak generally about it. Okay, and actually there was one other thing that I wanted to compare it against, which is this. And there's a reason why. Okay, so this purple line, which I kind of want to change to candles. Except now it looks too similar, so you might mix it up. So I'll just do a line. It's fine. Okay, so that's Visa, the stock Visa, like, you know, the credit card company. Okay, so there's a big interrelationship between these things and other things as well, but this is kind of what it boils down to. Okay. As the United States population increases, there's more people in the workforce. More people in the workforce means more productivity and increase in GDP. The country as a whole, the economy does better. Obviously, it has recessions and it has bull markets, and there's times where the economy does better and times where it contracts a bit. But the whole general trend for the U.S. economy is upwards. Okay, and there's obviously, that's a very easy correlation to establish. As the population increases, basically the stock market goes up. Okay, it's not, that's pretty simple. Okay, but how does it interrelate to these other things? Well, on a little bit of a smaller scale, inflation also tends to have a positive, or the rate of inflation. Okay, so the rate of inflation, not inflation, but the rate of inflation tends to have a positive correlation with the stock market as well. So as you can see, sorry, it's kind of jumping around. When inflation goes up, the market tends to go up too. And then they won't crash exactly at the same time. One may lead the other, but generally, as a market crashes, the rate of inflation will go down as well. That's because, obviously, the Federal Reserve intervenes with interest rates. They begin increasing interest rates, and they make lending harder. So it's harder to fractionally reserve lend, right? Less people can get loans. Fractional reserve lending becomes harder. Less money is created, essentially. But that's kind of what's going on, but there's also a big thing going on with the Treasury Department, right? So the real, what's the real reason for this giant rate of inflation happening? Well, that's because when COVID happened, the government gave out all those stimulus checks and paid people a lot of unemployment. Well, the government doesn't want to be at the bad end of the deal. Everyone knows that Uncle Sam is a greedy bastard and he's in it for himself, meaning that the government does rip off its own citizens. People are generally poorer now than they used to be. Obviously, our quality of life is increased because of technology and stuff, but the relative wages for any given job position are actually lower than they used to be like 20 years ago, 30 years ago, right? So that means they're putting the squeeze on all of us. And so when COVID happened, they did give everyone those stimulus checks and everything, right? And everyone liked that money. But the thing was, they almost doubled the entire supply of money so that they could do that. So they didn't actually help us out. They basically halved the value of all of our existing money, but then they gave us stimulus checks, like little bits of stimulus checks. And the thing is, though, that the effects of that inflation aren't immediate. So everyone no one bats an eye at it, and they think that the government's doing them a favor by giving them stimulus checks. But if the value of your cash just depreciated by 80%, obviously that effect will take time to play out, but that's not a good thing. You know, if the government pays you $3,000, or they do that a couple times, so they pay you $3,000, $6,000, maybe $9,000, maybe some unemployment, but everything that you can currently own that's cash is 80%, is worth, it won't quite be 80%, but it's worth pushing 80% less. They totally screwed us over, right? So that's why, but then all of that extra cash that got printed, well, it doesn't actually get printed, it just gets created electronically with the push of a button, gets invested into major stocks, especially major tech stocks, which pumps the market up, right? But the market is in a lot of ways artificially inflated by creation of more cash reserves, right? Like literally creating more money, right? But it's a zero-sum game. Money is a zero-sum game. I've talked about this on my channel before. So when they create more money, the existing amount of money depreciates accordingly. That's just simple market economics, like supply and demand. The supply of money increases, the value decreases, right? Anyway, so as the population increases, the supply of money increases, the value of the money decreases. That means there's more people every day in the world and in the US, and there's less wealth to go around because it's being depreciated. But I said the market is a zero-sum game, right? So that means if the value of your cash is depreciating, that means something has to be appreciating accordingly, because if your cash is losing that value, that means it has to balance out somewhere else in the whole free market, right? If your cash is worth less, that value can't be destroyed, right? So if your cash is worth 80% less, that means something else will become worth 80% more, which is essentially big tech stocks like Nvidia. So if you've been financially struggling the past few years, more so than previously, it basically boils down to, it's because all of your wealth got taken from you by financial institutions and the government, and essentially put into Nvidia. Basically, that's an oversimplification of it, but it's kind of the general gist. Okay, so your wealth got taken from you and put into Nvidia, and it got put into big tech stocks, and it got put into Visa. The reason I pulled up Visa instead of Nvidia, well, Nvidia obviously is in the S&P, so it's driving the S&P. So we already kind of have a Nvidia-backed asset here, but Visa is important because credit card purchases and spending are very important in an inflationary system, because they also will indicate something similar to Nvidia. As you can see, the trend of Visa is very similar to the S&P. Now, obviously, Visa is in the S&P 500, but it's not the exact same as Nvidia. It's kind of its own thing. It's based on spending, right? Which, I guess, again, related to Nvidia, but still different because it's more of a financial instrument rather than a tech instrument. Okay, so I kind of am jumping all over the place. I didn't organize this great, but I hope this is starting to give you a bit of the picture of it, right? So the wealth is being displaced, people's cash is depreciating, inversely correlated assets are appreciating. So, and think about it this way. if your cash is worth less, you have less money to spend. What does that mean? That means you're going to buy more with credit cards, right? So that means you're going to be using Visa. I could have pulled up MasterCard as well. It's going to be the same type of chart. MasterCard has a very similar trend to Visa. And I bet you no one has ever recommended Visa or MasterCard as good investments. You don't see that on Wall Street Bets and stuff. But I'm telling you that Visa, I mean, it's pretty high now, but I believe it will just continue to go higher in the long run. But Visa was one of the best investments you could have ever made in the stock market in human history. Visa is one of the best investments. Again, I'll say it again. It was one of the, and still is one of the best investments you can make in the stock market. Not financial advice. I'm not allowed to give that on YouTube, but I'm just telling you, Visa is one of the strongest stocks that has ever existed. Okay, and people sleep on it, but it tells everything. It tells all the writing on the wall. Okay, but anyway. So as inflation increases, people are being bankrupted. That means they have to take out more loans or they have to spend more on credit cards. So an increase in credit card spending means an increase in debt. I could have pulled up a debt chart, but basically, if you look at the Visa chart and you look at the United States national debt chart, they're going to look very similar, right? So what I'm here establishing is that the U.S. national debt, consumer, and the average household debt, as those things go up, tech stocks are also going up and stocks of credit card companies are also going up. That's not a coincidence. That's what I'm trying to establish here. Okay, people don't like to talk about this, but basically the poorer you get, the richer the credit card companies get. Does that make sense? In a world where money is a zero-sum game, and when you lose money, someone else makes money? Oh, gee, that makes a lot of sense, doesn't it? Okay, so, but not only that, but as you get poorer, tech stocks also get richer. Companies like Nvidia, Apple, Microsoft, the big names. Partially because I'm willing to bet that you have a computer or a phone that uses some sort of technology from Apple or Microsoft. That means you're buying their products. You're loyal to their products. So they are taking your money, but it's bigger than that, right? Those companies are built off of you losing money through inflation, because the people who are taking your money, people like Visa, guess what? I don't know the inner workings of Visa, but I'm willing to bet that, companies that are big are asset managers. They have assets under management. So financial institutions and stuff, when they are taking your money through inflation and through interest rates, they are then reinvesting those profits into what they perceive as being the best investments, which most likely are things like the S&P 500, which is driven by the biggest stocks in America, or they'll be investing in like the NASDAQs and the Dow Jones. So they'll be investing in all the companies. It's not just tech companies, but the biggest companies that are built off of taking money from the average household, the average consumer. Okay, so is this making sense? Is what I'm saying making sense to you? Okay, so it's not just inflation, it is interest rates as well. Interest rates do have an inverse correlation with inflation rate, though. There is that, but they're used, in my opinion, as a sort of, they make it seem like it's a checks and balances system, but what I really see it as is it's a way of obscuring just how badly people are getting fucked over, pardon my French, by inflation. So what they do is, because the inflation rate is a rate, that means that money is always inflating. Okay? So every day, essentially, new money is created by the Treasury. So every day, your existing money is worth less. Okay? So if the inflation rate is 2%, your money, even if the Federal Reserve was able to maintain an inflation rate of 2% annually, that would mean that every year you would lose 2% of your wealth. Okay? That's if they can keep it at a consistent rate. But what they do is they play these tricks where they try to push it down to a target of 2% inflation. But don't ignore the fact that inflation from 2020 to 2022 went absolutely bonkers. It was like, what was it, like 8%? For a couple of years, it got up to, I mean, it wasn't just there for 2 years straight, but it rose up to 8%. And so you might be happy that they got it down to 2% here, right? I don't know why this is, oh, that's a relative thing. Yeah, but like, see, if you scroll out, the inflation rate year over year looks pretty bad. Look at that. See? So they use this shit to hide that I mean, again, this is just the way the charting is like calculating the numbers, so it's not, that's not the hard figures, but the inflation rate is constantly fucking you over. The only thing that you can thank the Federal Reserve for is that sometimes at least they're fucking you over less. But the only reason they're really doing that is because if they allowed inflation to spiral out of control, yes, they would all get rich and siphon everyone's wealth, but then it would get so bad that Americans would revolt, or just the whole world would revolt, and they'd overthrow their governments. They'd kill. I'm not gonna say anything violence. I'm not encouraging violence by any means. Okay, this is just the way the world is. Just accept it. Don't get upset about it. Okay, just learn to play the game. But they would overthrow their governments. They would dispose of their, anyway, and the reason I'm saying that is because that's what's happened in history. If you look in communist Russia, guess what they did when Russia allowed inflation to spiral out of control because they were too greedy and they enacted inflation way too quickly. That government collapsed, right? Because the people rose up against it and said, this is way too extreme. So what the United States has figured out is if they do that very, very, very slowly, but not too slowly, they can rip everyone off and get rich a little bit slower. But what they can do is make the quality of life good enough that people won't complain about it too much. But why do you think homeless rates, the homeless amount of people, the percentage of the Americans that are homeless is increasing? It's literally because of this chart. Okay, the things I'm showing you. Like, literally Visa is to blame partially for things like homelessness. The Federal Reserve and the Treasury Department are to blame for things like homelessness because they are enabling an inflationary system which fucks over people, and the people who are struggling the most, eventually the poorest people who have wages and stuff, well, eventually they will start to slip into homelessness, right? And so the lower class gets worse, and the middle class starts to become the lower class, and the upper class starts to become the middle class. Okay, except for the very tip-top people who are the wealthiest, those people get richer, right? Because there's a balancing effect. But they just figure out a way to try to cut as many people out of that wealth as possible. Okay, and so they're slowly siphoning the wealth from everyone below them. Okay, so, but yeah. Anyway, so that's why I was saying that whole thing. Like, I'm not advocating for overthrowing a government or anything like that, because here's the thing, this is inevitable. Any government that exists will inevitably start to do this, okay? It's just because people are greedy. And it could be a lot worse than this. So if you want to go look into history, just look at how bad inflation and how quickly it's happened in certain countries, like especially communist countries, which aren't really communist. They're just it's just capitalism masked under another guise. Because the people in the government just end up being the capitalists. They hoard all the resources. So there's not much of a difference if the government's holding all the wealth or a corporation's hoarding all the wealth. It's just people in power who are taking the wealth from everyone beneath them. It doesn't matter if you call them left wing or right wing. They ultimately kind of have the same agendas, unfortunately. But it is what it is. That's the whole purpose of government, is to control and siphon wealth from people and benefit from their productivity. I'm not saying it's all sinister, that everything government does is evil, but ultimately it is. The people who are most motivated to run governments are self-interested, and they do financially benefit from doing so, correct? Okay, so anyway. What this means for you as a trader is in terms of projecting where the market will go, I would say, generally speaking, if interest rates are going up, or you expect them to eventually start going up, you can expect the market to start going up. If interest rates are continuously falling, that's where you expect the market to sell off. Okay, so I'm going to just, yeah, it's the blue line. Okay, so for example, take COVID. Interest rates they weren't very high here. They look high compared to here, but this is zero interest rates. As interest rates fell, the market decreased. Once interest rates hit zero, however, they can't go any lower. If interest rates can't go any lower, the market can't go any lower. And if interest rates are at zero, unless somehow interest rates go negative, which they won't, at least not in the US, if they can't go any lower, the market can't go any lower. And if they're not going to go any lower, that means eventually they're going to do what? Go higher. So that's why, even while interest rates stayed at zero, the market went up, because it was anticipating, because the market is forward-looking, it's anticipating the eventual arrival of higher interest rates. But this is where something really tricky happened. As the market crashed in 2022, right near the end of the bear market, there was a big promotion from financial institutions about high yield savings accounts and like even interest rate collecting checking accounts and all this stuff. They started promoting accounts where if you park your cash into like a checking account, but usually it was mostly like a high yield savings account, or it was like money market funds or treasury bonds. Treasury bonds got really big last year, right? They were even promoted in the Barbie movie. There was a line deliberately placed there, and the Barbie movie was funded by 3 of the biggest financial institutions in the United States. Cough, cough. And then about a month or 2 after the Barbie movie came out, the treasury bond yields went down. And, anyway, but they promoted high yield savings accounts at the end of the bear market, back to my original point. So everyone, as the market was crashing, a lot of so-called smart money managers and hedge funds started getting out of the stocks because they thought, oh no, it could crash another 30%, which is just the stupid logic of the less informed people on Wall Street and stuff. If you were holding here, why would you sell here? That doesn't make any sense. You know that it's an appreciating asset in the long run. But again, most people are too scared to like actually ride their life savings on that truth, because they are so scared of a black swan event where the S&P goes to zero, which can't happen. It literally can't happen. Okay. Anyway, so all these people, all these quote unquote smart people, they sell all of their S&P positions, their NASDAQ positions, and they put all their money into a 5% yielding interest rate account, even though inflation rate at that time was like 8%, so they're still losing money. As soon as the market tricks all the people into doing that, and they get out of the tech stocks, then the people in the know can start driving up the prices of the tech stocks again, or just of the stocks in general, the companies, right? As soon as they get all of the less informed people, or just the somewhat informed people, as soon as they can cart all those people out of these assets, then the assets can go up again. That's what they did here. So that's why you saw inflation going up still while the market was crashing. These things aren't perfectly timed, because if they were perfectly timed, it would be too obvious and then everyone would see it, right? So it can't happen all exactly at the same time, but it's these general understandings that you have to have that will help you to trade the market. Okay. So, but historically, when inflation goes lower, the rate of inflation, goes lower, the market can go higher. So inflation has been held at the rate of inflation has gotten down to a lower rate currently, correct? It's being held there. They haven't changed interest rates in 3 months, which is why the inflation rate is being held. As you can see, as one is staying the same, the other is going to stay the same. Okay, generally speaking. Unless, here, the reason that inflation went up here, well, interest rates were zero, yes, but also it's because the government created a bunch of more currency to bring the market up. So it's about the how much money is being created, where interest rates are at, and what the inflation rate is. They're all kind of interrelated. But obviously, the more money they're printing and the faster the rate they're printing money, obviously that's literally what inflation is, right? But interest rates and inflation have a relationship too. So if they increase interest rates, that will decrease the rate of inflation, right? But again, like I said, it's just their way of masking the fact that they're bankrupting America, okay? And they're taking all the money for themselves. Anyway, looking forward though, I would say that the market is bullish, generally speaking, which is obvious because the market has always been bullish, generally speaking, looking forward. There are bear markets, there are big recessions. As you can see, the S&P had 2 recessions where the one happened and it didn't even really take out the highs of the previous one, and then it took out the lows of that one. So it was kind of a ranging market for like 10 years, from the dot-com crash, the recovery, and then the financial crisis, right? So it can do that for a period of time, but like even then, even during this stuff, think about how many people got shaken out of being permabulls on the market, right? Especially during this panic. And the thing is when this stuff's crashing, this is where you buy. You have to have enough account size to handle the drawdown as you're catching a falling knife, but you have to, like when this market crashes, you should catch a falling knife. And the further it falls, the more you should try to catch it, because think about this. Anyone who bought the financial crisis of 2008, 2009 is literally probably a billionaire now. Like depending on how much size they bought with, but they're at least a millionaire or a multi-billionaire. So there are bull and bear markets, and sometimes this market like ranges for, a decade or even more. But the ultimate long-term trend is up, correct? So you kind of have to rely on that as a trader, and that's the most stable that you're going to get, in my opinion, in terms of like bias. Like this does go up in the long run, but look at this. Like for example, if you take the 60s, something very similar to the dot-com bubble and the financial crisis happened, where it made a high, but then it took out its previous bear market low, and then it made a higher high, but then it crashed even lower than the previous low. So some people call that a triple wedge bottom or whatever. I don't think that really matters. It's just that they were essentially running stop losses. And so this can happen for, boom. Yeah, it's like 10 years, right? So there can be 10 years where the market has strong bull markets and but also really strong bear markets, and it becomes hard to catch that bias. But in the long run, the people who really stay in this game are the people who stay permabulls, and they just keep adding size, taking out loans, doing whatever they can to buy more into these assets during recessions. But anyway, I wasn't really paying attention to the rate of the inflation rate back during then. But as you can see, sometimes it seems inversely correlated, but it's not. But like for example here, the market's at a low when inflation's at a high. It's kind of similar to what happened with the bear market of 2022, but it's just because they don't act at the exact same time, but they are causing one another, right? So here you see prices inflating while the market decreases, but it just means that it took longer to play out, right? So again, it's not going to be perfect, it's not going to be obvious to see, but if you know what you know, when you see what I'm saying, the market is driven up by inflation, essentially. So and inflation will continue indefinitely. So what I'm telling you is you should basically be a permabull, but expect some big recessions here and there. Now, how do you time those recessions? That gets into some Michael S. Jenkins stuff. You can time recessions. I called the bear market of 2022 to the day, not because of my own knowledge, but because I was using a technique that Michael S. Jenkins taught me. He said that there's a 2,339 day cycle. So watch this. You want to see something cool? Let me take this stuff off. I'm going to show you something really cool. For the people who had enough patience to stay through the whole video, you're about to see something absolutely mind-blowing about the market. Okay, this is some of the most, even though it doesn't happen that frequently, this is some of the most useful information you're going to find about the stock market. Ready? The low of the, hold on, volume's pissing me off right now. Okay, there we go. All right, I need volume to stop. Fuck off. Okay, so the final low of the bear market from the dot-com crash, in the S&P at least, is October 10th of 2002. Okay? Watch this. 10/10/2002. Exactly 2,339 days later, which this is not going to seem relevant to you right now. Let me just preface this though. This number was derived using a formula from I forget exactly where, but it was basically from a high to a low. They took the seed of the high and the low, and I forget exactly what he did. I'm sorry. It doesn't really matter. What matters is that he identified a time cycle. So 2,339 days from then is March 6th of 2009. Okay? March 6th of 2009 is the exact day of the low of the financial crisis bear market. Okay, so if we take this date and we put in 30609, we're just going to put that in here. Watch this. We add 2,339 days to that. We get August 1st of 2015. Okay? Now we're going to go to August 1st of 2015. August 1st of 2015, it's right here. Right here. Guess what happened after that date? Shortly after. Big crash in the market. It wasn't perfect to this date, but it was right here around the high of the market. This was the real high, but it was within 2 weeks of it. So then there was a crash in the market. Okay, so this is a confirmed cycle. So guess what I did? This is how I predicted the 2022 bear market. Add another 2,339 days to that. What do you get? December 26th of 2021. Now some of you already know what's coming, but if we go to December 26th of 2021, which is right here, guess what? It is within 1 week of the final high of that bull market. That is not a coincidence. That is a recurring cycle that happens. That's how I predicted the crash in 2022. But also knowing my knowledge about these assets, even my basic knowledge back then, which was about 2 years ago, I didn't expect a bear market to last more than a year. It didn't. It lasted about 9 months, which was my estimate for that bear market. Anyway, you can look back at my channel. In early 2023, I was calling for a bull market. I was saying the bear market's over. It's been over for a few months and it's going to continue. I literally, some of my first videos that I posted financially were during this crash. And what was I saying during this crash? I was saying it's a buy signal. When everyone was freaking out about the bank panics and the Silicon Valley bank panic and all that stuff, I was saying the institutions are buying. Okay, they're promoting a sell narrative on the news to deceive the masses, and it's actually going to be a bull market, and look what's happened. Okay, so now, why does this matter to you? Well, it won't matter to you for years, but guess what? In May 22nd of 2028, which within a week of that, I would expect there to be a major shift in the market. If it's a bull market up until that point, it will crash. If it's already crashing up until that point, it's a buy signal. Okay, so this is 4 years away from now, but I would mark this date down. This could be a life-changing gamble. You could buy options for 6 months out on this date, or within a week of this date. Let's say the S&P is at an all-time high around within a week of this date. Guess what you do? You buy puts for 6 or 9 a year out, 6 or 9 months or a year out, buy puts that are way out of the money, buy some in the money puts too, just to watch how they go, you will literally make, you will literally 20x your investment, right? So these opportunities come once every 2,339 days, which is about 6.4 years. But these opportunities are gold mines. This means every 6 years, you have an opportunity to 20x your net worth. If you could 20x your net worth every 6 years, you'll be a billionaire within a few decades, if not sooner. Correct? So, just giving you guys a little tidbit for the people who stayed to the end of the video and didn't click away because of a short attention span or thinking I'm a kooky tinfoil hat guy. I'm just here to just give you guys some truth, okay? So, now I did say potentially NVIDIA could have a blow off top recently, but I will kind of rescind that speculation because they didn't decrease interest rates, right? Because they held interest rates the same, well, this could still be a blow off top, but I think it's unlikely. To me, this looks bullish still. We'll see. But unless they start decreasing interest rates, I would expect the market to continue bullish, right? If you see that the market begins to, or speculators begin to actually price in a rate cut, which probably won't happen until in FOMC where they actually decrease the interest rates, because it'll probably come as a surprise once it actually happens. I kind of forgot how I started the sentence, but basically, if you see them cut rates, I would expect the market to sell off. Okay, so if you see them cut rates, I would actually consider switching my bias to short on this market for the short term, on the NASDAQ, the S&P, NVIDIA, whatever you're trading. But until they cut rates, I'm still probably bullish. But again, if they hold rates for long enough, eventually the probability of a rate cut is going to increase, and as it increases more, then the likelihood that the market will sell off will increase. Okay, and so the reason I'm saying this is because there's a common misconception that there's an inverse correlation between interest rates and text into the market. And the thing is that switched during the .com bubble is when they went from being inversely correlated to positively correlated. I don't know exactly why, but it just happened. But people are still believing the old way that things happened, where when interest rates went higher, which actually I don't even know if that's exactly how it was before, but it was just more chaotic. But the old way of thinking that's still spread around on Wall Street bets and stuff is that if interest rates go up, the market should sell off, and if interest rates go down, the market should go up. And that couldn't be further from the truth. So, yeah. Anyway, this is long-winded again. I'm sorry, but I really hope this helps you. I know I didn't explain it all perfectly, but I hope this just gets your gears turning in the right direction, thinking about the market in the right way from a macro perspective. Because my last video was all about day trading, but this is about the long-term bias, and this is why I don't really take short trades on the NASDAQ. Okay, think about it. Okay, NVIDIA kind of is the NASDAQ right now, not completely, but for a large part it is. Do you think it's smart to short this company? No? Okay, then why would you short the NASDAQ, even if you're day trading? Think about this. If the price is all the way up here, if you just pick a random day, if you just threw a dart at a random day, what do you think the odds are that it was a green day versus a red day? Do you think the odds of a green day are higher than a red day? Yes, then you honestly shouldn't short this unless like I said, interest rates get cut, something like that, black swan event happens, whatever. Then obviously there's an opportunity, right? And that's the thing about the market is, generally speaking, short selling has to be more fundamentally based. There has to be a black swan event. Something actually has to shift. Something unexpected has to shift that's going to cause people to sell. It's going to trigger people to try to get out of the asset for a period of time. All that selling is going to cause price to fall. Generally speaking, though, you shouldn't obviously be ready. That could happen at any time, but I would, generally speaking, assume that these assets will tend to go up in the long run. Okay, so anyway, take care, guys.